It wasn't a sudden disruption in mining supply. It wasn't a coordinated squeeze by industrial buyers. It wasn't even a speculative frenzy on the futures market. It was the inevitable mathematical consequence of monetary dilution. The pattern is unmistakable. Throughout history, whenever an empire reaches the limits of its expansion, it turns to the same mechanism. It debases the currency to pay for what it can no longer afford. The population eventually senses the shift. Capital begins to flee paper promises. It flows into tangible reality. Silver has always been the quiet refuge during these transitions. The arithmetic is merciless. We are watching a historical cycle repeat with absolute precision. To understand the future of silver, we must look at the graveyard of currencies past. 3 specific empires tell the story. 3 warnings from history that map directly to today. Look at the Roman Empire. The year is 64 AD. Emperor Nero faces a fiscal crisis following the Great Fire of Rome. The legions demand payment, and the treasury is empty. Nero chooses the easy path. He debases the silver denarius. He reduces the silver purity from 100% to roughly 90%. It seems harmless at first, but the incentive to cheat is too strong to resist. By the mid-3rd century, under Claudius Gothicus, the silver content has collapsed to barely 5%. The currency becomes bronze dipped in a silver wash. Trust evaporates completely. Prices for wheat and labor skyrocket. A Roman centurion, once paid in sound silver, finds his salary buys nothing. He demands payment in goods, not coins. Real silver disappears from circulation as citizens hoard it. The economy demonetizes, and the empire crumbles from within, just like Rome. The Spanish Empire fell into the exact same trap. The 17th century, Spain controls the New World and its vast mineral wealth, yet the crown is bankrupt from endless wars in Flanders. King Philip III and his successors turn to copper. They issue the vellon, a currency of pure fiat decree. They force citizens to trade their silver for copper at face value. The payoff is short-term, liquidity for the state. The cost is long-term ruin for the people. Inflation rips through cost style. A merchant in Seville watches the price of bread double, then triple. He stops accepting the king's copper tokens. He demands silver by weight. The economy bifurcates into a shadow market of real money and an official market of worthless scrap. The Spanish middle class is wiped out, and the empire enters a long, slow twilight. Just like Spain, the Weimar Republic believed it could print its way to solvency. Germany, 1914 to 1923. The costs of World War I are immense, and reparations are crushing. The government suspends the gold standard and turns on the printing presses. At first, the inflation is manageable. Then it becomes exponential. The paper mark loses value hourly. But here's the detail often missed. While the paper mark died, silver held its purchasing power. Those who held silver coins survived the storm. Those who held paper starved. A Berlin factory worker in 1923 receives his daily pay and rushes to the shops. He is not looking for luxury. He is looking for anything tangible. A silver spoon, a candlestick, a wedding ring. The flight to hard assets is the final desperate act of a population realizing their money is a lie. The pattern repeats in 7 distinct stages. Stage 1 is the era of sound money, where the currency is backed by metal and the government lives within its means. This rarely lasts, as political ambition eventually outpaces tax revenue. Stage 2 is overextension, where the state engages in foreign wars or massive domestic welfare programs, causing bills to pile up beyond what the treasury can cover. Stage 3 is the turning point, the chosen shortcut, where the government begins to debase the currency to monetize the debt. Stage 4 is the onset of inflation, where prices begin to rise and authorities blame speculators or supply chains, rather than their own monetary policy. Stage 5 is the denial phase, where the government implements price controls or capital controls to force usage of the currency. But the market knows the truth. Stage 6 is the flight to safety, the critical moment where public faith breaks and capital flees into land, gold, and specifically silver. Stage 7 is the reset, where the old currency is abandoned and a new system is introduced, often anchored back to hard assets to restore confidence, just like Weimar. The The modern global economy is showing clear signs of entering stage 6. Current data suggests we are transitioning from denial to flight. The deficits in major Western economies are structural, not cyclical. The debt-to-GDP ratios have surpassed historical danger zones. Central banks find themselves in a trap. If they raise rates to fight inflation, they risk bankrupting the sovereign by making debt service impossible. If they lower rates to save the sovereign, they unleash a new wave of inflation. Under these constraints, the rational move for smart capital is to exit the debt system entirely. Silver sits at a unique intersection in this unfolding drama. It is both a monetary metal and an industrial necessity. The green energy transition requires massive amounts of silver for solar panels and electronics. The supply is inelastic. Mines cannot simply ramp up production overnight to meet a price spike. We see a structural deficit forming where consumption outstrips mining supply. The incentive for industrial users is to secure inventory now before the price moves. The incentive for investors is to front-run the inevitable repricing of real assets against appreciating currencies. Some economic historians note a counter-argument. They argue that silver has lost its monetary premium and is now purely an industrial commodity, subject to the whims of the business cycle. If the global economy slows, they claim, silver demand will crash along with copper or steel. However, this view ignores the monetary history we just examined. In a currency crisis, the industrial demand becomes secondary to the monetary demand. When faith in sovereign debt breaks, the demand for portable, private wealth explodes. Silver is the accessible gold. It is the hard asset of the common man. Furthermore, the industrial demand floor is higher than ever before. You cannot print silver. You cannot quantitatively ease a silver mine into existence. The geological constraints are real, and the monetary pressure is building. We face 3 potential endgames. The first is controlled decline. This looks like the 1970s in the United States and Britain. Inflation runs hot for a decade, real wages fall, and the currency loses significant purchasing power. But the system holds together. Silver prices in the 1970s exploded, moving from roughly $1.50 to nearly $50 at the peak. The second endgame is chaotic collapse. This is the Soviet Union in 1991 or Zimbabwe in 2008. The political structure disintegrates along with the currency. Hyperinflation destroys the middle class, and silver becomes a medium of exchange